Chapter 3, Lecture 4. Other factors that affect analysis is inflation, disinflation, and deflation, and then other elements of distortion in reporting income. I'll have a slide on each: inflation, disinflation, and deflation. You might get a few questions out of there on the next exam or a case study maybe. Other elements of distortion in reporting income, in my opinion, crosses over into that accounting realm as opposed to finance. So you might not have a lot of questions on that, if any. But really understanding the inflation, disinflation, and deflation side. I know it's economic related, but it does affect doing, say, pro formas or other financial. Inflation could show increase in sales without an increase in output for goods or services, and should use economic data to account for increasing inflation rate each year. Pretty much the biggest thing to know about inflation is it averages about 3%. There are other things you can look at as far as inflation versus economic data. I'm not going to get into a lot of nitty-gritty with that. I'll save that for an econ class or further financial analysis. This is more of an introductory to financial management. Disinflation, slowing inflation rates, could cause lower earning projections. Not necessarily bad, it just may cause shareholders to settle for perceived less values in the company. It doesn't mean that the management or the company itself is heading in the wrong direction. It's just disinflation is affecting the projected outcome. Deflation, which is the opposite of inflation, that could also affect the outcome, that maybe your assets aren't worth quite as much as they were in the past. Examples of this occurring was in the United States from 2007 to 2009. Value of assets decreased relative to purchase price, specifically the housing market. You had a home that was worth $200,000 in today's standards, but you bought it for $250,000 back in 2007. That's an example of deflation occurring. Income statements showing higher reported income versus a conservative firm. So you can do those with different things as far as your projections are concerned. And sales, firm may defer revenue recognition until each payment received or full recognition at the earliest possible date. Cost of goods sold, use of different accounting principles, LIFO versus FIFO. That can affect what you're reporting on that, and varying treatments of R&D costs, etc. It can go on and on as far as explaining different discrepancies. Extraordinary gains or losses, inclusion of extraordinary events in computing current income or leave them out. Net income, use of different methods of financial reporting, inclusion, exclusion of extraordinary gains and losses. Each time in the financial statement analyzed rather than accepting bottom line figures. This is another explanation of discrepancy. And that is the end of Chapter 3, Lecture 4. Again, very short, just understanding the inflation, deflation side is what you would be most required. So thank you very much, and we'll get into Chapter 4 here soon.